Welcome to Everyday Economics, a podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our great podcasts at americastalking.com. To support Everyday Economics, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Monday, March 6th. And joining me, as always, my partner, Dr. Orphe Divounguy, PhD economist. Dr. O, I think of the text messages that you and I send each other and of the conversations that we have between shows, my favorite are always about the hyperbole of the social media takes on the economy. It wasn't Armageddon yesterday. It wasn't Armageddon the day before, 3 weeks ago, 5 weeks ago. But today it is, because the Dallas Fed is calling out this threat of a global housing slide, and it's going to take the U.S. housing market to its knees, Dr. Orphe.
It's interesting. I actually take a look at the Dallas Fed paper. The first version came out in March 2022. And what they do here is very, very interesting. They look at the momentum in the price to rent ratios and the price to income ratios.
So we're taking data that has to do with rents
and prices. And the idea is very simple. They expect that if the price to rent ratio accelerates really rapidly, right? In other words, prices become disconnected with rents very rapidly, then it's probably driven by a lot of speculation. You're seeing a bubble forming potentially in the housing market. And so that has to correct, right? If same thing for price to income, right? If prices get too high relative to income, the housing market becomes very unaffordable. At some point, there must be a correction in order to bring those two numbers, those two variables back in line with each other so that people can actually continue to buy homes. That is the theory that is in the data, and the methodology they use is very, very novel. It just shows that, that whenever you have this momentum increase in the price to rent ratio or the price to income ratio, well, the prices tend to come back down to adjust downwards. And as beautiful as that is, let me break this down for our listeners. The rent, why is the rent so important? The rent is the potential. It can be viewed as the potential income stream from a property. If you don't live in your house, right, and you put it up for rent, will the rent be enough to cover your payment, your mortgage payment? And so that's why the price to rent ratio is so important. Because if you were to put your house up for rent today, if that rent could not cover your mortgage payment, you would be in trouble. And it's similar to when you look at stocks, the price to earnings ratio in the stock market. A high price to earnings ratio in the stock market usually indicates that investors have bid up the prices of that stock or that particular equity because they expect higher future earnings growth. Right. So if I'm buying up a bunch of Tesla, it's because I buy Tesla because I think Tesla is going to make a lot of money in the future. And that will justify, earnings will increase so much, it will justify me bidding up the stock price of Tesla, buying a bunch of Tesla shares. That's how you can compare the price to income, the price to rent ratio with the price to earnings ratio in the stock market. So let me ask you this, Chris. If you were to put your house up for rent today, would you be able to get rent high enough to cover your current mortgage payment?
I'll tell you, yes. But where I live, the bigger problem would be my monthly obligation to property tax. So, I'd have to worry about the whole enchilada. It would be tough, right? It would be close. It would be, in my view, it would be in the ballpark.
Exactly. And for my neighbor who has a 2.8% mortgage rate payment, right? Mortgage rate, 30-year fixed rate, putting his house up for rent, when rents have increased tremendously. They peaked 17% in February. They're still up, 7-8% year over year. So if my neighbor was to put his house up for rent, he would easily cover the whole 9 yards. He would cover his mortgage payment, mortgage insurance. If he has mortgage insurance, he would cover absolutely everything and even have a little left over. And so that is the reality. The reality is that we've never seen a housing market where sellers were in such good position, where homeowners are in such good position. In fact, this month in the month of January, what we saw is housing demand kind of increased a little bit. Pending listings going pending sales went up. Pending listings went up. But we saw that new listings were still down roughly 17% when compared to a year ago. Fewer homeowners were listing their homes. We've never seen that before. In the past, every housing crash was led by sellers not being able to make their monthly payments anymore. And because they weren't able to make their monthly payments anymore, they put their house up on the market. And at the time, they didn't have any home equity either. They put their house up on the market. They couldn't lower the price sufficiently to sell the house. They had to foreclose.
Very different times, right? The dot-com bubble in 1999 wiped out a lot of, wealth in the United States. And the opportunities to buy that existed between homes, and specifically between 1999 and 2007, there were a lot of products that still exist today, but they're way more gimmicky and way more exposed to changes in rates.
And a lot of fraud. Let's be honest. There was a lot of fraud going on back then.
Yes. There were a lot of people that were in the mortgage brokerage industry who were not mortgage brokers.
Oh, I know so many people were like, oh yeah, I made a lot of money selling mortgages. I'm like, when did you start selling mortgages, man? It was terrible. So we're in a situation. And by the way, you can go back to the late 80s. Right. Every time early 90s, every time the housing market had a little bit of a dip, it was mostly driven by sellers flooding the markets with units. Today, we're not seeing that. Sellers are sitting back because they are locked into a 30-year fixed rate. They have high enough credit. Their monthly payments are super low. So yeah, we're not seeing that. And so when I see these really cool, I want to call them econometrics exercises, well done, but it's so far-fetched from what's going on right now in the housing market.
I think that's a good way to end it. Far-fetched. That's the final word from Dr. Orphe Divounguy. For Dr. Rowe, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.